Okay, what's going on, everyone? This is going to be the first video for chapter 5, right? We're looking at gross income and exclusions. So hopefully everything is going along well so far in this course. You're understanding what's going on. But as an overview, right, we'll look at kind of gross income, the difference between realization and recognition. So we'll kind of harp on that again. Other income concepts, judicial doctrines, so kind of legal doctrines that tell us kind of shaping mechanisms or the rules that we need to apply whenever we're looking at income. Then we'll look at all the different types of income and then all the different types of exclusions. Okay? So the focus of this chapter, if we were kind of taking it back to that like Mario level, we're really just looking up here at the top part, hey, what would we include in our gross income? Right, so as a starting point, right, gross income is all income from whatever source derived, right? Really broad kind of component to it. We're talking about worldwide income, right? So if you make money in Italy, for example, right? Say you have $100,000 that you make in the US and then 20,000 that you make in Italy, right? They're going to tax you on 120 in the US, right? So you'll have 100 of US source income and 20 of foreign source income. We will see, and somebody may say, right, hey, this is unfair because in Italy they tax that $20,000 and then in the US you're taxing it as well. We don't really like that idea of the same income being taxed twice. So to kind of alleviate this, and we'll learn more about this in this chapter and future chapters, tax law provides a couple different mechanisms, right? There is the foreign earned income exclusion, which basically says up to a threshold amount, assuming you more or less live in that foreign country all year, you can just exclude it on your US tax return. Again, this is for earned, not passive income. You can get an itemized deduction for foreign taxes paid. Perhaps the most common, though, is the foreign tax credit, right? So essentially, they will give you a credit on your U.S. return for those taxes paid to the foreign government. It's not that simple. There's limitations on that, but generally, right, we do have these kind of relief mechanisms. In this framework, right, because we have kind of worldwide income and all this stuff, we do have to keep this in mind when we do the returns, right? One of the things the government, right, does not want you to do is more or less hide money overseas, right? So there are two different forms, right? The FBAR in the 8938, kind of two different agencies there, right? We have the FinCEN for the FBAR and then the IRS for the 8938. But basically what these say is something along the lines of if you have foreign assets, foreign bank accounts, foreign investments, and they exceed a certain threshold, you need to disclose this on these kind of return items here. Big thing in practice and important because even though these forms are easy, it's just like listing out what you have. If you fail to disclose them or you inaccurately disclose them, big time penalties for these. Okay, so we're talking now about gross income, right? It's kind of like gross, he's picking his nose over there. It's all income from whatever source derived. And in this framework, right, you are going to recognize income, i.e. put on the tax return when there's an economic benefit, a realization event, and basically nothing in the tax law says, hey, you can exclude or defer this item. Right, so the first thing here is an economic benefit, right? You generally have to get something of value. Most common is, right, your employer is going to pay you in cash, right? You work for your company, they pay you, you get money, hey, there's an economic benefit. It could be other things, right? They could pay you in property, you could get services. There could be other kind of rental income or passive income that comes to you. COD income, we'll talk about. One thing that is not an economic benefit or event, though, is borrowing money, right? So let's say you go to the bank, you borrow $50,000. Someone might say, hey, do you have $50,000 of income because you got that cash? Well, borrowing is not an economic event, i.e. there is no income here, essentially because there's an equal and offsetting obligation to repay that borrowing, okay? So you need that economic event. There needs to be a realization event, which basically says, hey, there's a measurable change in property rights. So like before, I didn't have that much money, but now after, right, I got something. It's kind of like a before and after. In this framework, one thing you do have to be aware of is there's definitely a difference between realization, like a realization event, and unrealized gains or losses. When we talk about unrealized gains or losses, these are not going to be taxed. So what does this mean, right? Hey, we buy Apple stock for $1,000, right? It goes up, it goes down, right? But at the end of the year, right, maybe it's now worth $5,000, right? We haven't sold it. It's just a holding gain, right? It's an unrealized gain. Someone might say, hey, should you have $4,000 in income here? Well, this is not a realization event. We're not going to report any income in this case. There's no holding gains or losses. Compare that with, right, hey, it goes up to $10,000, right? We then sell it, right? I.e., there is a realization event. We would have income there for the difference, right, on what we made, $9,000 of a gain, okay? So why do they do this, right? Well, it's easy to capture when you sell it. And also, if you had to have these like unrealized gains, that would create a headache of tracking that every year. So we're really just looking at a realization event, a before and after. Typically, it's just you get paid in money. But when we're talking about selling stuff, you actually have to sell it. And then recognition says, hey, we actually have to put this on the return. As a general rule, right, we talked about realization equals recognition most of the time, but there are exclusions and deferrals. We'll talk about all the exclusions in this chapter. So with that said, right, let's start to talk about some kind of other income concepts here. So it says form of receipt. The IRS looks at more than just cash transactions. That is, taxpayers can receive non-cash property and/or services in bilateral non-gift economic events. Generally, everything you receive is valued at its fair market value. What does this mean, right? So say we have Kirby, right? He is cleaning, right? He's providing cleaning services to Luigi, Yoshi, and Mario, right? Luigi is like, look, Kirby, I will pay you in cash $100, right, for that. That kind of gets sucked into Kirby and is valued at $100. He's going to have to report the income, right? It's essentially like he's working for $100. Someone may try to be sneaky, right, and essentially say, like Yoshi over here, like, hey, I'm not going to pay you in cash. I'm going to give you this egg that is worth $300, right? Because we didn't exchange cash, right, you won't have to claim that as income. That would be wrong, right, because essentially we're earning this income here. And when we value it, right, it will come in at $300, right, the fair market value, not what Yoshi paid, right? Yoshi may have paid, you know, $100 for that or something, but we don't care about what we paid in the past for it. We care what it's worth. Also, it could be services, right? Kirby's like, look, I will clean your house, Mario, if you, in return, like build for me a driveway, right? You pour a driveway for me or something like that. Whatever that is worth, right? So maybe that driveway or fixing a pothole or something is worth $200. Whatever service Mario is providing, that kind of comes in, and Kirby is going to have to claim this at the fair market value. Okay? So kind of building off this, or one variation is bartering, right? Where you trade goods or services. Again, this is going to be a realization and recognition event at the fair market value. So we have Daniel, right, and Mr. Miyagi. If you've ever seen Karate Kid, right, essentially what happens is Daniel does like chores for Mr. Miyagi. Mr. Miyagi teaches him karate. There's no cash exchanged here, right? Nobody is getting any money. Is there income? Well, the answer is going to be yes for the fair market value received, right? So Mr. Miyagi, right, what does he get, right? Well, he gets Daniel painting his fence, right? So whatever that is worth, the fair market value, Mr. Miyagi is going to have to claim. Likewise, what does Daniel get, right? Daniel gets Mr. Miyagi teaching him karate lessons, right? So this is no different than that kind of Mario example where he builds the driveway, right? Just because there's no cash doesn't mean there's no income. Okay, so let's look at some examples here. Just kind of look at this. Hey, we buy a stock, it fluctuates in value. Is there any realization event? No, right? Holding gains and losses, i.e. unrealized gains and losses, we're not going to report. We talk a little bit here. It shows, hey, we have a taxpayer who babysits for their landlord. The landlord says, hey, I'm not going to charge you any rent, right? So in other words, their rent is $750. If you watch my kids, you won't have to pay that. Both people, namely the landlord and the tenant in that case, will have to claim income for the fair market value that they receive. So the tenant would be not having to pay rent. For the landlord, it would be whatever the fair market value of those babysitting services are. Okay? Another kind of income concept that we have to be aware of is the tax benefit rule, right? And it basically says no double dip, right? They're not going to give you a smiley and smiley on there. We'll talk about what that means. But as a starting point, right, when we talk about refunds, specifically, for example, income tax refunds, I do my tax return, I get a $2,000 refund, it's not going to be taxable, right? That's generally going to be a return of capital, money that was like already yours in there. Interest on a refund, right? If you like delay getting your refund 5 years and then the IRS pays you interest on it, well, that interest would be taxable. But that's going to be kind of the starting point on there. When we build it out for other refunds, other type of refunds, specifically, let's talk about, for example, business expenses. Or like a simple above the line deduction. Let's say that in year one, right, we're self-employed, we bought a laptop, right? So we bought a laptop in December of year one. Let's just say it was $2,000, right, the laptop. And we took the tax deduction for that, right? It's like a business expense, an ordinary and necessary business expense. That's a smiley face. That's a good thing because we got a deduction. But then we wanted to be a sneaky taxpayer, right? And then we just went in year two and we returned that laptop or that computer. We got our $2,000 back, i.e. we got a refund. In this case, the IRS is not going to let you game the system, right? Like smiley, take the deduction and then return it, get your money back with no consequences. Second smiley, right? We need to even this out, right? In other words, in that way, in year two, for example, or year three, you now would have a burden of $2,000 of income, right? We kind of have to essentially just restore what happened there. So it's the idea of the tax benefit rule. It's kind of smiley, frowny on there. It gets more complex whenever that deduction in question was an itemized deduction. The reason for this is the standard deduction essentially acts as like an anchor or a baseline. And for this reason, itemized deductions only produce tax benefits in the prior year to the extent they exceeded that standard deduction. Specifically, the amount of refund that is taxable is the lesser of the refund amount or the amount the itemized deductions exceeded the standard deductions. That's a mouthful. Let's look at this with some numbers over here. So it's not always the case that this happens, right? You kind of have to do the math and look at it. But let's just look at two different examples, right? Here's kind of example one, right? In year one, right? So it was kind of the prior year. There were 20 of itemized deductions and 15 standard deduction, right? So obviously you're going to pick the bigger of those two. That's great. That was kind of the smiley you took in year one. Let's say then in year two, of that $20,000, you got $1,000 refunded back to you on there. Maybe it was like a charitable donation that you got back, a medical expense you got reimbursed for. In this way, right, if we were to kind of rewrite the story here, you still would have itemized in year one, but the difference there, the one, namely all of the refund, you got a $1,000 refund, and then all 1,000 of it is going to be the frowny, the income, right? So in that case, right, it just follows the general rule of, hey, you get a refund, it's taxable. So all refunded equals all income. All refunded equals all frowny. Here's where it gets kind of wonky, and I said it gets a little bit more tricky. All refunded equals some income, right? So if we look at this one, right, in year one, the standard deduction was 17, and our itemized deductions, I'm sorry, the standard deduction was 15, and our itemized deductions are 17. Just rewrite that there, no big deal. So again, obviously we would have done that. But now, right, we get refunded $3,000, right? So if we were to kind of rewrite history here, right, in year one, it would have been 14 versus 15. Hey, we would have taken the standard deduction. The upshot of this, right, whenever we kind of do the comparison on this is, yes, we got a $3,000 refund. However, only $2,000 of that, right, the difference essentially between there, because we have that standard deduction as an anchor, is going to be income, right? So here's where it's kind of mapped out, right? The first example, right, we got a $1,000 refund, right, where all of it is going to be income. Here's the second example, right? We got a $3,000 refund where only some of it is going to be income in year two, the frowny face, because that standard deduction essentially acts as like a baseline or an anchor there. We would have gotten that anyhow, right? That kind of shaded area, that $1,000, we would have got either way on there. Other items to be aware of here is under the tax law, right? You can have accrual method taxpayers versus cash method. Typically, and at a very like kind of generic level, very big C corps are going to have to use accrual method, and then most individuals, right, are going to use a modified version of the cash method, right, where essentially it says cash in is income, cash out is expense, but it kind of has tweaks to it. With that being said, right, if most individuals are cash method taxpayers, you might get a sneaky taxpayer who says something like this, right? So, oh, here we are at year end. My boss gives me a check for my year end bonus of 10 grand, right? I'm just going to wait until next year to cash that check because then I can like get some deferral there and not have to claim it on my current year return. Can you do this? Well, the answer is going to be no under this constructive receipt doctrine, right? It essentially says the cash method taxpayer realizes and recognizes income when it's actually received, right? You literally get the cash, or constructively of the law received. Constructively here basically means you had access to this, you could have cashed it, there were no kind of strings attached for there. We're not going to let you just sit on this income until the next year. Okay, so that's the constructive receipt doctrine. We also have the claim of right doctrine, which is kind of like the opposite of the tax benefit rule, right? Because this is like frowny, smiley. What this says is when a taxpayer receives income in one period, but must return it in another period, right? We're going to have income in the first period and then a deduction in the second period. By way of example, right, say you were to get like a $2,000 signing bonus in year one, right? Then you quit your job in year two or year three and you have to repay that signing bonus. Well, in year one, you would have to include that in your income. And then in year two, right, you would get a deduction on your return for it. Other items, kind of shaping mechanisms here, judicial doctrines. The assignment of income doctrine, right? This essentially prevents taxpayers from shifting their income to others. It's not absolute, but it does give some rules here. Right, so say we have Uncle Phil, he's really rich, he's in the 37% tax bracket. And let's say we have Carlton, who's maybe in like the 10% tax bracket or the 0%. Uncle Phil may try to be sneaky and say something like, look, instead of paying me, law firm, just put the money in my kid's account, right? And then I'll let him claim it and he can pay 10% on it. Can't do that, right? The assignment of income doctrine says this, right? Essentially, he who makes the income has to claim the income. She who owns the asset has to claim the income generated from that asset, right? So kind of like the fruit of the tree has to go to the tree. Another iteration of this might be something like, let's say Uncle Phil owns a piece of property or a bond or something like that, right? He tells his tenants with that rental income, don't pay me, pay Carlton. Because Uncle Phil owns that property there, he has to claim it. There is a workaround, right? There is like a workaround, there is an exception to this, and it basically says, look, If you, Uncle Phil, right, if you transfer ownership of this, i.e., you basically give the house to Carlton and now it's Carlton's house, or if it was a bond, right, if you gave him the bond, then and only then can you shift the income. But like anything, right, you have to give the house over to him. So now you better hope Carlton manages this appropriately. Community property systems versus common law, you can read that, right? Most states are going to be common law. The exception is community property. We'll now talk a little bit about income and exclusions, right? So we'll maybe get into a couple income items and then we'll pause it. But the lay of the land, right, we're going to look at different types of income. That's great. Some of this is obvious. Some of this you might not have known. Then we'll say, okay, those are all the things you have to include. Here are all the things you can and are allowed to exclude. Okay, so it's kind of like if it's green, check mark, it's income. If it's red, X, we're going to exclude it. Okay. All right, the starting point is going to be income from services. This is typically associated with earned income, which is in distinction to more like passive income. So it would be like salaries, wages, tips. Yes, tips are taxable income, right? I've heard people say before, like, oh, well, I'm a waiter or waitress. They don't pay me minimum wage, so my tips aren't taxable. That is wrong. You have to include tips in your income on there, right? So your first job, right? If you're working at a fast food place or something like that, that might be an example of earned income. Contributions to traditional retirement accounts, so like for example, a traditional 401k, typically going to be excluded for federal income tax, but not FICA on there. Sometimes people confuse that, like it's if you put into your 401k, yeah, you don't have to pay income tax on that now, but you will be subject to FICA on that now. And then on the flip side, right, whenever it's pushed out, it will be taxable as ordinary income. So very common setup here is I contribute to my 401k. To the extent I contribute, I won't pay income tax on it now, but later on in retirement, when I receive the distributions from that 401k, they will be taxable. Gets a little bit more wonky once you get with like Roth accounts involved, but assuming it's a traditional account, that will be the framework. You can also be paid an equity-based compensation. For example, stock options, restricted stock units, right? Very common in kind of the tech field here, in the startup field, where you could maybe get like a smaller salary, but then, very high, stock compensation. That is going to be taxable income. For how much and when it's taxable is kind of beyond the scope of this lecture because it gets really complex. But do be aware, like you can't just be like, oh, okay, we're going to pay you in stock and then you don't have to claim any of that as income. Okay? So that was kind of active income, and that's in distinction to more kind of passive income. There's also kind of portfolio income, another variation of this. It's also kind of unearned income. So you're kind of sitting around, right? You get your dividends, you get your interest, your rental income on their royalty income, annuities. All this stuff is going to be taxable to you. So interest income, obviously, if you get it from a bank account, from a corporate bond, not a muni bond, but from a corporate bond, from a U.S. Treasury security. One thing here is this original issue discount, this OID. So there's that associated tax form from Chapter 1. You may see this in practice. But this basically is a form of interest income, right? So going back to your financial accounting days, right, there may be $1,000 bond that's issued for $900, right? So you pay $900 up front, you get some interest payments, and then you get $1,000 on a back end for it. The difference between that, right, the $100 in that case, the IRS isn't going to just let you wait until the end of the bond or whatever to claim it. They'll effectively just treat it as interest income throughout the bond on there. So it's a variation of interest income. You open up a bank account, do be aware if they give you kind of a sign-on bonus for that, you will get a 1099 for that. That's taxable income. On the flip side, credit card reward points, assuming it's like a personal credit card, generally not going to be taxable. It's looked at sort of like a discount on it, almost like a coupon. Okay? Let's talk a little bit about annuities here. So an annuity, what is it? It's a steady stream of equal payments over time, right? So it's like an allowance, right? So for example, your allowance, if you get 20 bucks, 20 bucks, 20 bucks, 20 bucks, it could be like a car payment, right? 500 bucks a month, 500 bucks, 500 bucks a month. That's kind of the standard definition. When we talk about it in, accounting and tax, like we tend to think about it as a financial investment in that case. Right? So say we have grandma, right? And essentially she wants to buy an annuity in retirement, right? So she may pay $10,000 and receive 11 payments of $1,000, right? So she pays 10 and she gets 11 on there. And for her, it makes sense, right? Because, you're paying 10, you get 11 over time. From the annuity company, it makes sense because maybe they're making more than $1,000 over that time. The thing with this is, right, the IRS isn't going to let you just wait, right? Like if here's the timeline, right, like all this time, right, they're not going to just let you wait until the end to claim that $1,000, right? Instead, what they're going to say is every time you get a payment in the annuity, right, some of that is essentially going to be taxable, right, going to represent that earnings, and some of that is going to be not taxable via return of capital of that upfront investment on there. Gets a little wonky here, right, because there's a difference between a fixed annuity and kind of a lifetime annuity. This situation is fixed because it's like known, right? It's for 11 payments, it's a fixed amount. With a lifetime annuity, it's for the rest of grandma's life, right? She could live 10 years, she could live 20 years, she could live 30 years. Maybe she's like that, like a tech guy who's doing all those like crazy body things to live forever. I can't remember his name on there. So in that case, right, when it's a lifetime annuity, we're going to have to go to kind of the projections, the IRS table, to kind of figure out what's going on. But let's give this some numbers and look at it, right? So there's some information, tax benefit rules, some of these shaping doctrines on there. You can look at these items, nothing too hard here. Here's where I want to look at the annuities. Okay, here's an example of a fixed annuity. We'll start with that. So let's say grandma purchases an annuity for $99,000. It will pay her 10 grand a year for 15 years, right? So it's going to pay out 150. She receives her first $10,000 payment in December year one. How much of this payment is income, right? So what we have to do here, right, when we kind of go back to the PowerPoint, right, we're going to have to use this thing called the exclusion ratio, right? In other words, every time we get the payment, right, how much of this payment is taxable versus not taxable. This is where we'll kind of use this item here, right? So if it's maybe here $1,000 payment in this situation, maybe 600 is income and 400 is excluded. But the idea here is it's essentially going to be your cost over the expected value of the annuity, right? So in this case, going back to the example, she paid 99. The expected value, i.e. what this thing is worth, 15 years, $10,000, $150,000, we get a percentage there of 66%. So hey, she gets her first payment of 10 grand. Right, in this way, 6.6 is excluded. If 6.6 is excluded, then 3.4 is included. Okay, nothing too hard there. You have to memorize kind of the formula, but if you can do simple math, it's basically what you paid over what it's worth. That gives you the percentage that tells you what is excluded on there, not what's included. Sometimes people mix that up. Finally here, let's look at the variation of a lifetime annuity, right? So kind of similar setup here. She pays 99. It's going to give her $1,000 a month for the rest of her life, right? So we know cost is 99, but the expected value, right? Grandma could live 5 years, grandma could live 30 years. What we have to do in this case, right? She's 70 years old. We would go over to the table here that basically gives us the projection. hey, 70, here's the multiple 16, right? So 12 payments a year, $1,000 a payment. There's the return multiple. We expect this thing is going to be worth, in light of the projection of grandma's age, $192,000. So when it's a lifetime annuity, you have to use the table to figure out the denominator. That gives 52%. She receives a $1,000 payment. 52% is excluded, 516. If 516 is excluded, then 484 is included. Okay, so nothing too hard there. We're at about the half-hour mark, so I'm going to stop it here, and we will see you in the second video.